Yes, I mean, if you look at at a kind of below the surface level, so that the headline indices are not always a good indicator of what is being priced with regards to vaccine optimism, and the way the market is trying to discount the economic impact of a reopening. The pessimism has built greatly. It peaked sort of end of November, mid-December, and has been obviously coming down as we've had to factor in the idea of mutations and second wave and further lockdowns. So much so that I think there's now a pretty big dislocation between either the vaccine pessimism is too great, or the market level is too high. I also think that the positioning has been very difficult to handle, because investors, having looked at the huge moves that we saw in November, particularly from a rotation perspective, are aware that they can't really afford to miss out on that. So you have to be somewhat positioned. And yet when you're waiting for catalysts to come through, that positioning can start to become a bit stale, and then everybody's unwinding. And indeed, when we look at things like most shorted names, etc., and the moves that they've been having, there's clearly a big degrowth event that's going on at the market at the moment. However, we've got a catalyst coming potentially next week as further vaccines start to come online, and the process starts to improve and accelerate. I think that confidence is going to be restored to the market.
How important do you think capital returns are for the investor community this year? I was speaking to the CEO of UBS yesterday, and they announced a reasonable amount of money to be given back to investors in the form of share buybacks. And they're one of the banks who are leaning more on buybacks versus dividends in the coming years. Is that a growing theme for European companies, do you reckon, in the next couple of years?
It's a very good question, and actually, it's one it's one to follow quite closely, particularly from a dividend versus buyback perspective, which has implications for other products, and particularly in the derivative space. Clearly, having dividends having been marked down such a long way last year, one wonders whether or not certain sectors are now thinking, okay, fine, is there more flexibility in a buyback program than perhaps having a dividend? And is that, if we do believe that our shares are trading at a material discount, or our cost of equity is too high, is that actually a better use of the capital? So we're very, very early on in earnings season at the moment. But as you point out, we've already seen a few of the bigger names announcing these programs. And it's something that we're going to be following in terms of trying to establish whether or not the kind of culture is moving a little bit more away from perhaps dividend distribution, which in a world where yield is not really available in any other format, perhaps becomes less of an emphasis, and more towards buybacks and looking at the flexibility, and whether or not that's a better use of excess capital in terms of the cost of equity.